Jerome Powell is reportedly under criminal investigation. The former president is openly talking about firing him. And meanwhile, your mortgage rate, your stock portfolio, and even Bitcoin's run to six figures are all chained to whatever happens next at the Fed. So no, this isn't just DC drama. This is your rent just went up drama. Let's talk about what's real, what's YouTube fantasy, and what it actually means for your money in the next 6 to 12 months. Welcome back to the comment section with Thomas Paul, where we try to keep your portfolio safer than my parents' savings were when they trusted a bank advisor in 2001. Spoiler, it did not end well. Let's start with what's being reported in plain English. There are reports of a criminal-style investigation involving Fed Chair Jerome Powell. The chatter is that it may be tied to how some Fed facilities were used and possibly ethics and disclosure issues. That's the serious part. Here's what we do not have. We don't have formal charges, we don't have an indictment, and we don't have a clear public timeline. We're not at orange jumpsuit, perp walk, roll the Netflix documentary level. But if you scroll finance YouTube right now, you'd think Powell is already packing a toothbrush for prison. Titles like Powell going to jail and Fed reset is here are everywhere. And here's where things get interesting. There's a massive gap between the legal reality and the content that farms your fear for clicks. Procedurally, to actually remove a Fed chair, you don't just need bad headlines. The Fed chair has a term. To be kicked out mid-term, you'd need serious legal findings or a political process that decides he's committed cause for removal. That could involve the president, lawyers, and probably a Senate-level political war. It's slow, ugly, and very public. So no, a single leak doesn't mean he's gone next Tuesday. But wait, it gets even wilder when you add politics. Trump has ramped up his attacks on the Fed again and is openly talking about firing Powell or putting someone more loyal in the seat. Markets care about that a lot more than they pretend. Why? Because the Fed is supposed to be the boring adult in the room. Their job is to keep inflation expectations anchored, even when politicians want cheap money before an election. If markets start to believe, oh, the Fed will just cut rates because the president yells at them on TV, then long-term inflation expectations can slip higher. And when that happens, long-term bonds get smoked, the dollar weakens over time, and every risk asset from stocks to junk debt gets repriced. I remember working at a local newspaper in college and watching how the same economic story sounded totally different with a different headline. This is that, on steroids. Trump versus Powell isn't just soap opera. It's about who controls the on/off switch for the cost of money. Now, let's connect that drama to what's happening in markets right now, because investors are already voting with their wallets. Gold is at or near record highs. People don't buy gold because they feel calm and trustful. They buy it because they're worried about inflation, currency debasement, or a crisis in confidence. At the same time, Bitcoin is sprinting toward that magical $100,000 number in a lot of people's models, sold as a hedge against money printing, Fed failure, and some ominous reset that apparently always shows up just in time for the thumbnail. Here's the key point. A weaker, more politically bullied Fed can pump both gold and Bitcoin at the same time. If people think the Fed will cave, cut too fast, and let inflation stick around, hard assets benefit. Gold gets love as the old-school inflation hedge. Bitcoin gets love as the new school, forget your central bank, I'm opting out asset. Stress and credibility risk are actually fuel for these trades. You'll also hear people tying this to a supposed 2026 money reset, big debt problems, high deficits, the system needing a reboot. Whether you buy that exact year or not, the narrative is the same. If the Fed looks shaky, more investors grab anything that's not a promise from the government. Now let's cut through the noise and talk in scenarios, because that's actually useful. Scenario 1, the investigation fizzles, Powell stays, and the Fed keeps its basic independence. In that case, what should you expect? More volatility, for sure. Every headline about Powell under fire will jolt bonds, gold, and crypto. But the broader policy path, gradual cuts if inflation cooperates, still talking tough about price stability, stays roughly intact. That's the boring scenario. Usually boring is good for long-term investors. Stocks can keep trading on earnings and growth, not just central bank drama. Scenario 2. The probe doesn't remove Powell, but it weakens him. At the same time, Trump's pressure and political attacks ramp up. Now the Fed looks more vulnerable. Market odds shift toward earlier or more aggressive rate cuts driven partly by politics, not just data. In that world, inflation has a higher chance of staying sticky above target. Short term, that's usually good for gold, energy, commodities, and yes, probably Bitcoin and other alternative assets. Bad for long-dated bonds, because who wants to hold a 20 or 30-year IOU from a government whose inflation-fighting credibility is slipping? Also bad for people sitting in cash too long if inflation quietly erodes their real returns. Scenario 3, the extreme one. Powell is forced out or basically sidelined, and it's obvious the Fed is being captured politically. That is a regime shift. You'd likely see higher risk premiums across almost everything, higher yields demanded on U.S. debt, a weaker dollar over time, more boom-bust cycles as policy swings with elections instead of data. Stocks can still do fine in that world, but it's choppier and way more sensitive to headlines. Hard assets and globally diversified portfolios matter more. Safe, predictable, 4% forever bond math, much less reliable. Now, I'm not saying which scenario will happen. I'm saying your portfolio should not depend on just one of them. Before we talk positioning principles, quick shout out to the engine behind this channel. This video was created with Fludge.io, the same system that powers everything you're watching right now. If you're sitting there thinking, I'd love to run a channel like this, but I don't want to be on camera, I don't want to edit, and I definitely don't want to scroll news all day, that's literally what Fludge is built for. It researches trending topics in your niche, writes the script, builds the thumbnail, plugs in an AI avatar, and can even upload to YouTube. Your job, review, tweak, and hit publish. You can jump in at any step if you want more control, or let it run and just steer over time. It's not spam. If it were, you wouldn't still be listening to me right now. If you want that unfair advantage without burning out, check out Fludge.io. All right, positioning principles you can actually use in conversations with your financial advisor. 1. Diversify your interest rate risk. If the Fed stays strong, long bonds might be fine. If it gets captured or inflation sticks, long bonds are roadkill. You don't want your entire future riding on one guess. Mix between short, medium, maybe some long if it truly fits your plan. Not all in on one duration. 2. Keep some inflation hedges. That could be gold, commodities, real estate, or other real assets. For some people, a capped Bitcoin allocation might make sense as a speculative hedge, but capped is the key word. 5% of your portfolio being volatile is a story. 50% is a personality disorder. 3. Avoid all or nothing bets on a 2026 reset or any specific date. The world rarely blows up on schedule. Narrative trades are tempting, but my best investment win was something boring and unfashionable in my 30s that just worked slowly. Hype burns out. Fundamentals compound. 4. Watch policy signals, not Twitter meltdowns. If you care about your portfolio, pay attention to actual DOJ announcements, real Fed statements after meetings, and any serious moves by a president to change Fed leadership. Those move mortgage rates, not some rando on social yelling "end the Fed" for the 50th time. And no YouTuber, including this channel, knows if Jerome Powell is going to jail. We do know that messy politics around the Fed increase uncertainty, and the way you fight uncertainty is with diversification, position sizing, and time horizon, not with clairvoyance. To wrap this up, this is not really about Jerome Powell, the person. It's about whether the Federal Reserve keeps enough independence to anchor inflation and interest rates. That's the backbone of everything from your car loan to the valuation on Apple stock to how high Bitcoin can fly in a panic. Key things to watch from here. Any concrete move from the DOJ, any escalation in Trump's threats to fire or replace Powell, and the tone of the next few Fed meetings. Does the Fed sound scared of politicians or scared of inflation? If the Fed sounds strong and boring, mortgage rates and stock valuations probably stay on a somewhat predictable path. If it sounds cornered and political, expect more volatility, more demand for gold and crypto, and more pain in long-duration bonds. Let me know in the comments, which scenario do you think we're heading toward? Status quo, weakened Fed, or full-on political capture? And how are you positioning for it, if at all? Hit subscribe if you want fast, no drama breakdowns every time political chaos crashes into your money. This is the comment section with Thomas Paul. Thanks for hanging out, and I'll see you in the next one. Quick disclaimer: nothing in this video is financial, legal, or tax advice. It's for education and entertainment only. Talk to a licensed professional before making investment decisions.